Bond markets have grabbed the steering wheel from equities, with yields and oil jumping and risk assets starting to wobble. This is vTalkInsight, Equity Pulse Daily for May 18, 2026, where we unpack what a global yield spike and an AI-driven earnings boom together mean for stock markets worldwide. Equity markets are now being forced to listen to what bond markets have been signaling for weeks. The inflation scare has hardened into a full-blown yield shock, and that is driving a repricing of risk across the equity complex. US 10-year Treasury yields have moved above 4.5%, while 30-year yields sit north of 5%. In Japan, the 30-year government bond yield has surged past 4%, recently trading around 4.44, its highest level since that bond was introduced. These moves are rooted in data and energy, not just sentiment. Hotter than expected U.S. consumer and producer inflation, together with Japanese producer prices rising around 4.9% year-on-year, are convincing markets that price pressures are more persistent than central banks had hoped. At the same time, Brent crude is trading above $107 a barrel and has flirted with $110 as the prolonged disruption around the Strait of Hormuz tightened supply. That combination of upside surprises in inflation and a renewed energy shock is a classic recipe for higher-term premia across global bond markets. Market-implied inflation expectations at the front end are now sitting well above 3% in the United States, directly challenging the Federal Reserve's 2% target. Investors are also demanding extra compensation for absorbing heavy sovereign issuance, with fiscal deficits still elevated and defense and energy spending rising. For equities, the message is straightforward. Higher real and nominal yields raise discount rates, leaving less tolerance for stretched multiples. U.S. strategists are already building a 4.5% 10-year and a flat Fed path into their S&P 500 frameworks, and many flag that a sustained move toward a 5% 10-year would likely force a more structural derating of equity valuations. We are starting to see that adjustment play out on screens. Global equities and bonds are both under pressure, and in the U.S. the S&P 500 has just posted a decline of more than 1%, with the VIX volatility index drifting back toward the high teens. In Europe, the Stoxx 600 is trading lower, with broad-based sector weakness. Rate-sensitive areas are feeling the strain, as European property names such as Unibail-Rodamco-Westfield and UK banks like Barclays sell off, while commodity-linked sectors lag under the weight of a stronger dollar and softer spot commodity prices. Energy adds another layer of complexity. U.S. gasoline prices around $4.50 a gallon are already prompting some substitution, but commentary suggests that clear demand destruction is more likely if prices push closer to $5. Until then, the energy impulse remains inflationary rather than demand-crushing. That mix feeds fears of stagflation, especially in Europe, where elevated energy costs, weaker purchasing manager indices, and headline inflation around 3% are colliding. The European Central Bank is expected to keep tightening to contain inflation, even though that risks amplifying downside pressure on already fragile Eurozone growth. The path of U.S. 10-year yields and Brent crude toward, or away from, the 5% and $120 thresholds will be critical signposts for the next leg of the equity move. Against this backdrop, policy divergence is reasserting itself across developed markets. In the U.S., the Federal Reserve is effectively on hold, but markets are now pricing in the risk of an additional rate hike by early next year as yields break to new highs across the curve. Incoming Fed Chair Kevin Warsh faces a difficult starting point. He is being tested by rising front-end and long-end yields, while several Federal Open Market Committee members voice concern that faster balance sheet reduction could threaten market functioning. The Fed cannot fix geopolitically driven energy shocks, but an overly aggressive response to persistent inflation could still become a policy mistake. In Europe, the European Central Bank is expected to raise rates further this year, even as growth momentum softens. Together with the Swiss National Bank, it is seen as prioritizing inflation control, which supports their currencies but raises recession risks. By contrast, the Bank of England is viewed as more growth-sensitive. Markets are flirting with the idea that it may be forced to hike in line with the ECB, but some see that as misaligned with UK-specific inflation dynamics. This tension between inflation fighting and growth protection is feeding directly into currency moves and sovereign spreads. The UK has become a focal point for how politics and policy interact with markets. Political instability around Prime Minister Keir Starmer and speculation about a potential Labour leadership challenge from Andy Burnham are driving heightened volatility in gilts. Investors worry that a shift toward looser fiscal policy would mean larger gilt issuance and higher long-term borrowing costs. 30-year gilt yields are already elevated, with some analysts suggesting they could move towards 6.5% if markets demand more compensation for fiscal flexibility. Sterling is reflecting that anxiety, delivering its worst weekly performance since 2024. Moves in the UK rates market have been dramatic, with frequent double-digit basis point swings in both directions. Long-duration gilts are seen as particularly vulnerable while political uncertainty persists, and many investors express a preference for intermediate maturities where growth and inflation risks are more balanced. Some observers stress that not all of the move is homegrown, pointing to hot inflation in the US and Japan as global drivers of higher yields. Even so, the combination of political noise and fiscal questions is widening the risk premium on UK assets. For UK equities, that shows up most clearly in pressure on banks and domestically exposed sectors, while a weaker pound complicates the outlook for companies heavily reliant on imported inputs. Alongside yields, geopolitics is playing a central role in today's equity narrative. The prolonged disruption around the Strait of Hormuz and the risk of further escalation in the Middle East are keeping an additional risk premium embedded in oil prices. Analysts flag that absent a diplomatic breakthrough, a major U.S.-led military operation targeting Iran is a plausible scenario, which would clearly unsettle energy and broader risk assets. At the same time, Iran's regime is described as stable and deeply institutionalized, suggesting geopolitical risk here is persistent rather than a quick, binary event that disappears overnight. There are also important structural shifts underway in energy logistics. The United Arab Emirates plans to double oil export capacity through a pipeline that bypasses the Strait of Hormuz by 2027, while Saudi Arabia is increasing exports via the Red Sea. The U.S., meanwhile, is emphasizing its own energy independence and expanding crude exports, including to Asian buyers. Over time, this network of alternative routes could make global oil flows less hostage to Hormuz, even though the region will remain critical for production. For equities, that points to ongoing capital expenditure in pipelines and ports and a gradual evolution rather than a sudden disappearance of the Middle East risk premium. Turning to U.S.-China relations, recent high-profile meetings produced more optics than substance. China's agreement to buy 200 Boeing jets fell well short of market hopes for a 500-plane order, and Boeing's stock price reflected that disappointment. There was some progress on soybeans and licensing for U.S. beef plants, and China agreed to purchase U.S. oil for the first time, which marginally supports U.S. energy exporters. However, sluggish Chinese consumption and overcapacity in meat production mean the ultimate volume uplift for U.S. agriculture remains uncertain, leaving a cloud over parts of the industrial and farming complex. The strategically sensitive issues around technology and critical minerals remain largely unresolved. China still controls up to 90% of rare earth production and processing, creating meaningful supply chain risk for Western manufacturers, especially in high-tech and automotive sectors. In response to renewed trade tensions and Chinese export controls, the U.S. is accelerating efforts to diversify rare earth supply chains and restrict sensitive technology exports. China is simultaneously ramping up domestic chip development to reduce reliance on U.S. suppliers. The result is selective decoupling in areas like AI, quantum computing, and advanced semiconductors, even as broader trade integration continues. Near term, there are some stabilizing elements. Ongoing dialogue and scheduled meetings between U.S. and Chinese leaders suggest a tactical truce that could last into a potential September summit, and markets see little sign of imminent escalation around Taiwan despite harsher rhetoric. Over the medium term, though, the relationship remains fundamentally competitive, especially in military and technological domains. For equity markets, That implies episodic volatility rather than a clean resolution, with particular sensitivity in semiconductor names facing export license uncertainty, global automakers tied into Chinese supply chains, and industrials exposed to rare earth availability and pricing. Set against this macro and geopolitical turbulence is an equity story that remains remarkably strong: the AI-led earnings cycle. Earlier in the week, major U.S. indices were still printing record levels, powered by technology and semiconductors, even as bond yields marched higher. Today's yield shock is testing that leadership, but the fundamental narrative has not disappeared. S&P 500 earnings forecasts remain resilient largely because of robust AI-driven growth, even as many non-AI sectors face meaningful downward revisions in projected earnings. AI-related capital expenditure is becoming macro-relevant in its own right. AI-driven capex is projected around $750 billion, up roughly 11% year-on-year, and is estimated to contribute about half a percentage point to U.S. GDP growth. Looking ahead, tech sector capital spending overall is expected to reach $3 trillion by 2028, supporting earnings and margin growth well above historical norms. Within that, AI chip demand continues to significantly outpace supply, with recent data pointing to a 20% quarter-on-quarter acceleration, underscoring why the semiconductor complex remains central to the equity story despite recent price volatility. Adoption metrics help explain the optimism. AI usage is still concentrated among large-cap firms, but practical use cases are emerging across sectors. Weekly active users of the CodeX coding tool, for example, doubled from 2 million to 4 million in just 30 days, with 9-fold and 10-fold growth in the UK and Germany respectively. On the infrastructure side, OpenAI's business mix is tilting rapidly toward enterprise clients. Enterprise revenue already accounts for about 40% of total and is projected to reach 50% by year-end, supported by surging demand to integrate advanced models into complex workflows. That growth sits on top of a record $122 billion in private fundraising, giving the firm significant flexibility to invest in compute, even as management signals it may tap additional capital if demand outpaces cash flow. Market behavior around AI-linked names shows both conviction and froth. NVIDIA has logged gains of around 20% in a single week, while Cerebra's initial public offering debuted as the year's largest with a first-day surge of roughly 60 to 70% before experiencing sharp volatility. Recent price action in names like Ford and Cerebras has drawn comparisons to past speculative episodes in blockchain and crypto. At the same time, a wave of upcoming AI IPOs and a surge in tech sector debt issuance suggest a shift from equity and credit scarcity to relative abundance. Major firms such as Alphabet are issuing sizable bond deals that attract strong demand, potentially crowding out some appetite for government paper and reinforcing upward pressure on yields. Individual company moves add valuable texture. Applied Materials exceeded sales and profit forecasts on strong AI-related demand, yet its shares only held on to a small gain after an initial jump, reflecting more measured enthusiasm as higher rates bite. Chipmakers globally are under pressure amid the broader risk-off tone, with declines in major Asian and U.S. names despite solid earnings and margin expansion. In software, Figma is rallying after raising its revenue outlook and easing fears about AI cannibalizing its business, while Pershing Square's new position in Microsoft signals ongoing institutional confidence in large-cap AI platforms after recent share price weakness. Beyond pure tech, sector signals are mixed but informative. U.S. industrials remain highly favored, supported by ongoing government stimulus programs in infrastructure and technology investment, even as valuation concerns grow. There are early signs of a capex recovery outside the largest S&P 500 names, with mid- and small-cap firms starting to increase investment in response to improving manufacturing and new orders data. In Europe, by contrast, rising bond yields are hitting property stocks and banks particularly hard, and European equity indices are underperforming AI-heavy U.S. benchmarks. Luxury and consumer names tell a more nuanced story, LVMH sale of Marc Jacobs to WHP Global, which is expected to lift WHP's revenues above $9.5 billion, and a 60+% surge in Sarah Russ shares point to investor appetite for targeted growth and brand stories. While Stellantis' renewed Jeep partnership with Dongfeng in China hints at selective opportunities in autos despite a challenging year. Pulling this together, the equity backdrop is now defined by a clash between a powerful AI-driven earnings and capex cycle and a bond market that is loudly repricing inflation and fiscal risk. Higher long-end yields, rising oil prices, and persistent geopolitical frictions are tightening the valuation screws on equities, even as AI-linked revenue and profit growth remain exceptional. The balance of risk is shifting from pure upside surprise toward a wider range of outcomes. A stabilization of US 10-year yields near current levels and a cap on Brent below $120 would give equities room to digest higher rates, while a push beyond those thresholds, or a sharp escalation in the Middle East or UK political stress, could accelerate an equity re-rating. On the opportunity side, breadth in capex and AI adoption beyond the mega caps is an important signal to track, as are the quality of upcoming AI IPOs and any changes in trade or export control policy, especially for semiconductors. For now, the key watch points are the path of global yields, the durability of AI-related earnings and cash flows, the evolution of UK fiscal and political headlines, and any surprise moves on energy supply routes or US-China technology relations. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.